Hello students, today we are going to discuss capital budgeting, one important topic of financial management. And under capital budgeting particularly we are going to discuss NPV methods today. Under financial management, capital budgeting, NPV method. This is our today's discussion. And today's session will cover discussion about definition of capital budgeting, definition of project appraisal, methods of project appraisal, NPV method of project appraisal, meaning and concept of present value of money, or you can say cash flow, present value of cash flow. And after all this discussion, we will have one illustration to solve. Solution of one illustration. That is also part of today's class, today's session. So, financial management, and in financial management there is a chapter capital budgeting, and under capital budgeting particularly we are discussing today NPV method. These are the topics, these are the items for today's session, today's discussion, and one illustration to solve. Okay, let us proceed. First of all, let us define what is capital budgeting. Definition of capital budgeting. Capital budgeting is a process of identifying, evaluating, and selecting the project or projects. When you are doing your exercise of capital budgeting, you may select one project or more than one project. So, selecting projects to be taken up for execution. So, in the process of capital budgeting and selecting and all this, the first thing is identifying projects and then evaluating each of the projects. This evaluation is actually what we are going to discuss later on. This evaluation is nothing but appraisal, project appraisal. We'll discuss this. After this definition of capital budgeting, we'll define what is project appraisal. Project appraisal is nothing but evaluation of each project. So, identifying the projects, then evaluating each project, and then selecting. On the basis of evaluation done, selecting the project, one project or more, to be taken up for execution, and finally you start executing the project. Once it is selected, execution. Out of many such projects to choose from, so you have number of projects in your hands to choose from for execution, to select. So you will select after proper evaluation or project appraisal, you select the projects for execution out of many such projects in hand to choose from. In such a way that is more important, in such a way that the selection of the project or projects satisfies the following requirements. So these are the requirements which you should keep in mind when you go on evaluating and selecting the projects. In the process of evaluation and selection of projects, these are the criteria actually. These are the criteria you keep in mind. Requirements. So following are the requirements which are required to be satisfied in the process of selecting projects. Let us see what are the criteria, what are the requirements in the process of appraisal and selection of projects. First of all, the selected project or projects gives the best possible return in the form of cash flows. Particularly we are talking about return in the form of cash flows, and to be precise, more maybe in the form of profit. But here we are actually more concerned about cash flows, cash generation. The projects, how much cash the projects will generate. That is the return. In this case, the selected project or projects gives the best possible return. So, best possible return. In other words, total return for the selected project is more than total return for the projects not selected. The projects which you have not selected, the return from those projects should be less than, obviously, than the project you selected. So the project you selected should give more return than the projects not selected. This is the first criteria. And second, net present value. Now, earlier it was only cash flows or profit. The best possible return in terms of cash flows or profit. Now, in the second part, second requirement is net present value of each or cash flows from the project or projects selected is greater than that from projects not selected. Now, net present value. The second criteria is to be considered net present value. Net present value of what? Of cash flows. So this is also one criteria, one requirement to be considered when you appraise the project and select the project. This is net present value. So how net present values are calculated? Net present value of cash flows are calculated. We'll see that in later part of this discussion. We will solve the problem, and also when we discuss the method, net present value method, we'll see how it's calculated. So this is the second criteria. And third, selected projects returns back. Selected project or projects returns back the initial investments faster than the projects not selected. So return backs faster. Selected projects returns back the initial investment faster. That means if you invest 5 lakh rupees in project A and the same 5 lakh rupees in project B, in terms of cash involvement, in terms of cash outlay. In terms of cash outlay, if you invest 5 lakh rupees in project A and 5 lakh rupees in project B, and if you find that 5 lakh rupees of cash outlay in project A, you are getting it back. You are getting it back in terms of cash flows in 3 years. And whereas in case of project B, cash outlay of rupees 5 lakh, the same amount, you get it back. You get the return of this outlay in terms of cash flows in 5 years. So obviously you'll go for the project A, because that project A is giving you this investment, this outlay back in terms of return cash flow in lesser period, lesser number of years, in 3 years. And whereas project B is giving you back this initial outlay, initial investment in terms of cash flows in 5 years. It's taking 5 years, 2 years more to give you back that initial outlay, initial investment or cash outlay. So obviously you'll go for project A, that gives you back the outlay, the investment in 3 years only. Whereas project B is taking 5 years to give you back that initial outlay in terms of cash flows. This is the second criteria. So third criteria, this is the third criteria. So fourth criteria, simple. You calculate ROI, return on investment. Return on investment, calculate return on investment using formula and see which project is giving higher return on investment, ROI. So the project giving higher ROI will be your chosen project. You select that project. Fifth, after that, number 5. Total capital requirement for investing in the selected projects is within the available resources or funds earmarked for investment in these new projects. So, within the available resources, total capital requirement. Obvious, this is very obvious criteria when you go for selecting projects. Your total capital, what total fund available in your company, if total capital available, total fund available for investment is suppose 20 crore. 20 crore is the total capital, total fund available for investing in new projects. So you can select projects, 1 or 2 or more. The total involvement, total capital involvement, capital investment required will be not more than 20 crore. Within 20 crore available funds. So that is one obvious criteria when you go for. Maybe you have very good projects in hand. You have very good projects, very profitable, fulfilling all earlier criteria. But required fund, if the required fund is more than 20 crore, then you can go for those projects. Even the profitable or beneficial or good projects in terms of returns and all other earlier criteria. See, here we are talking about total capital requirement. Total capital requirement within the available resources. Within the available resources should be within the available resources and funds. Now, here you should understand one thing: available resources. It doesn't mean only your own capital. Maybe you are talking to your fund managers, you are talking to your financiers from which you can borrow capital, borrow fund. So considering all these probable, all these feasible fund availability, including the financiers whom you talk to, financiers who are ready to invest in a fund in your company, financiers who are ready to invest in your project. You have talked to all those financiers or investors, outside investors and financiers, whom you satisfied, whom you satisfactorily explain about your projects and make them satisfied with the project, the viability of the projects, but to the total amount they have committed, they have agreed to invest or agreed to finance your project, take up the total amount, and if that total amount, within the total amount, you have to select projects within that total amount. That is the total availability of resources we are talking about. So, availability of resources is very important here. Availability of resources means your own capital, reserve the surplus which you have, the probability of raising capital to the market by issue of shares and debentures, or you just try and find out the probability and feasibility of raising capital to the market, and also probability and feasibility of raising capital from your financiers and investors who have satisfied with the project's viability and committed some capital. So taking all these will be available resources. Now the projects you will be selecting or choosing, the value of capital requirement, total capital requirement for those projects should not exceed that available resources. Understood? So that is this point, this criteria, this is the obvious criteria. The last point, project or projects selected for future investment if it is more than one, in line with overall objective or goal of the firm in terms of maximization of shareholders' wealth. Maximization of shareholders' wealth. So whatever decision you take in terms of selecting the projects or type of projects or number of projects to be chosen for execution, that decision about selecting projects, number of projects, type of projects, so that decision should be in conformity with maximization of shareholders' wealth. That should not violate the ultimate objective of the firm, of the company. Ultimate objective of the company is maximization of shareholders' wealth. So this is the overall objective. So that overall objective of objective and goal of the firm is maximization of shareholders' wealth. So whatever decision you take regarding selecting, appraising and selecting one project or more than one projects, keeping in mind all the above criteria, ultimately you should take into account this overall objectives of the firm, that is maximization of shareholders' wealth. That should not violate this objective. That means whatever decision you take, that should lead to increasing shareholders' wealth. That should lead to increasing shareholders' wealth. Not that due to that decision you take regarding selection and execution project, ultimately lead to decreasing shareholders' wealth. That should not be the decision. That should not be the right decision. So right decision should be which takes into account the overall objective of the goal of the firm, which is maximization of shareholders' wealth. So these are the criteria, these are the requirements you should keep in mind when you select one or more projects for execution. And this is the definition of capital budget. The first paragraph, I read it again. Capital budgeting is a process. So it's a process. It is a process of identifying. It's a process of identifying, evaluating, means appraising each one of the projects, and then out of these projects, available projects, after proper appraisal and evaluation, you select. Selecting is also part of this process. Selecting the project, one project or more, and then execution. The whole thing is called capital budgeting, this process. So this process is called capital budgeting. Identifying, evaluating, selecting one or more projects for execution out of many available, where you keep in mind these following requirements or criteria. These are the criteria we have discussed right now. These are the criteria, these are the requirements you should keep in mind when you select projects after proper appraisal or evaluation. Okay, this is the definition of capital budgeting. Now, the important word I told you about, evaluation. Evaluation is appraisal of the project in hand for selection. So how do you do that? How do you do that appraisal? Let us see, and first of all, let us see what is project appraisal exactly is, and then we will see what are the different methods of project appraisal. Okay. Now here we will discuss about definition of project appraisal in short. In short, what is the definition of project appraisal? Evaluation we talked about in the previous definition of capital budgeting. When we were defining capital budgeting, we talked about evaluation. So evaluation is simply project appraisal. So what is the definition of project appraisal in short? Project appraisal is evaluating. It is evaluating a proposed project. It is evaluating a proposed project by undertaking a cost-benefit analysis. Cost-benefit analysis. What is the cost involved and what are the benefits you are expecting to get from the project? So this is called cost-benefit analysis. Cost involved in terms of investment and uniform or annual expenses, initial investment and annual expenses. There's a cost involved, and what are the benefits you are getting out of those projects? Benefits mostly and mainly in terms of cash flows and other returns. So cost benefit analysis, you do the cost benefit analysis for each of the projects of different aspects of the project with an objective of determining its viability. So why do we do that? To determine objective of determining its viability. So cost benefit analysis, if we find that cost does not justify the cost involved, cost incurred to be incurred does not justify the benefits. You get low benefits, then high cost, then it's not viable. The project is not viable. If you are investing 10 crore, and if you find cash flows, the present values of cash flows, present value of cash flows, all the cash flows over the period of the project, maybe 5-6 years, whatever, it comes to 8 crore. So you are investing 10 crore, and the present value of your cash flows comes to 8 crore. So the project is not viable. It's obvious. So these are ways we find out the viability of projects, mainly by doing cost benefit analysis. A project involves employment of scarce resources. A project involves employment of scarce resources, money, capital is the most scarce resources. You can raise capital in the market, but not always is it possible. People will be ready to invest in the farm only when you justify your projects in terms of viability. So project involves employment of scarce resources, which is not easily available. Scarce resources, resources which are not easily available. Scarce resources. Resources are actually comprised man, machine, material, money. And at the end of the day, money is the main resource because money can buy machines, money can buy materials, money can buy manpower. So, money involved, capital involved is the main resource and which is not easily available. So that's why it is called scarce resources. So project involved employment of scarce resources. An entrepreneur needs to operate various alternative projects before appraise. An entrepreneur needs to appraise various alternative projects. Appraise is evaluate. An entrepreneur needs to evaluate or appraise various alternative projects before allocating the scarce resources for the best projects. Obviously, you see the resources are scarce, capital is not easily available, you will be very choosy when you select projects and invest your scarce resource, which is capital. So an entrepreneur needs to appraise various alternative projects before allocating the scarce resources for the best project. For appraising a project, its economic, financial, technical, market, managerial and social aspects are analyzed. So in the process of appraising a project involves analysis of what? Analysis of economic analysis, financial analysis, tactical market analysis, managerial analysis, and also social analysis, social aspects. What will be the impact on society about your new project? If your new project is such, it will be damaging the society or social aspects, social, maybe environment. I mean, we will talk about the environment. If it involves issues damaging the environment, polluting the environment, the project is not viable, obviously, because if you start the project, it will be closed by somehow, by people, by government, or whatever. You will not get the permission also, in fact. So, these are the aspects, social aspects, economic aspects, financial, tactical, market, and managerial issues to be analyzed in the process of appraising a project. The effects of a project appraisal are long-reaching and have very definite long-term effects because of the capital investments. Because your involvement of capital investment, maybe crores, hundreds of crores of rupees, 1,000 crores. There are big projects which needs thousands of crores investments. So obviously these projects have long-reaching effects. Effect of project appraisal are long-reaching and have very definite long-term effects because of capital investment that is always required in any project, and that capital investment may be huge. So much of money when you are investing, so much of capital when you are investing in a new project, you must ensure that the project is giving you proper return in terms of cost-benefit analysis. After cost-benefit analysis, so the appraisal should be correct, and that is correct appraisal. Correct appraisal has a long-reaching impact on the project, because project is not for a day or two. It may be 5, 6, 7, or 10 years, or more than that, 50 years. So that project appraisal has a long-reaching impact because of involvement of huge capital investment, capital requirement. Finally, financial institution carry out project appraisal to assess its creditworthiness before extending finance to a project. So that I discussed earlier also. When you go to the financiers or investors, maybe bank or other financial institutions, for financing your project, they will judge, they will carry out their own appraisal of your projects for which you are seeking for capital. You are asking for capital or asking for investment to the financiers and financial institutions. So before they commit their capital, commit their investment, the financiers and investment companies, banks and other financial institutions, they will obviously ensure that new project will be beneficial to them after they invest their money. They'll get proper return from their investment for the project of their to the extent of their share of investment. So that they will ensure before they commit their investments. So that is another reason why project appraisal is important from the point of view of financiers and investors, financial institutions and banks. So this is the definition of project appraisal. So to start with, the project appraisal is simply evaluating. Project appraisal is simply evaluating a proposed project by undertaking cost-benefit analysis of different aspects of the project with an objective of determining its viability. And the criteria we discussed when you discussed capital budgeting. This is the criteria to be followed and observed when you do the project appraisal exercise. Okay. Now, let us see what are the different methods of project appraisal. Methods of project appraisal. Project appraisal has basically two types of techniques. Different techniques are used. So they are classified into non-discounted cash flow. There are two types basically. One is non-discounted cash flow or traditional technique, and another is discounted cash flow technique. So this is the two techniques. One is non-discounted cash flow or traditional technique, and other sort of methods are under discounted cash flow techniques. There are several methods. Methods are classified. There are several methods for project appraisal, and all these methods are classified. They are classified. There are several methods, and all these methods of project appraisal are classified into two categories. One is non-discounted cash flow category, and another is discounted cash flow categories or techniques. So non-discounted cash flow category, non-discounted cash flow techniques or traditional techniques, non-discounted or traditional, non-discounted cash flow technique or traditional techniques. Under this category, under this technique, you have these are the products, these are the methods: average or accounting rate of return (ARR) method, payback period method, payback reciprocal method, and payback profitability method. We will discuss all these methods in future classes. Taking each one of these methods, we'll discuss with illustration in the future classes. Today, actually, we will discuss NPV method. So these are the non-discounted cash flow techniques. Now let us see which are the discounted cash flow techniques. These are the discounted cash flow techniques. Discounted cash flow techniques. Discounted cash flow. Discounted cash flow techniques. Under this category, you have several methods again: NPV method, IRR method, MNPV. NPV, the short form of net present value method. IRR, this is short form of internal rate of return method. MNPV, modified NPV method, and you have modified IRR, MIRR. This is modified NPV, this is modified IRR. And next you have PI, profitability index method, and you have a discounted payback period, discounted PV method, and finally you have adjusted net present value, adjusted NPV. You can call adjusted NPV method, adjusted NPV method. So these are the methods under discounted cash flow technique. Today, particularly, we will discuss net present value method, and we will go for solving one illustration under this method, net present value method. So net present value method, if we discuss net present value method, the simple formula to calculate net present value. See, you can easily understand if a project has positive net present value. I am going into details how we calculate net present value, but common sense, it's common sense. What common sense says, if you have positive net present value for a project, obviously you should go for that project. But if you have negative net present value, I'm telling you, I'm going to calculate or show you how net present value is calculated, but I'm just telling you here at the beginning, if a project is giving positive net present value, you'll go for that project, and if a project is giving negative net present value, you not select the project. This is what is telling here in the decision criteria. What is the decision criteria? Decision criteria for a single project. For a single project, I'm going into the formula later on, but first I tell you the decision criteria. For decision criteria is for a single project under consideration, the project will be accepted or selected or chosen if NPV of the project is positive. That means NPV is greater than 0. If NPV is positive for a single project, the project will be selected or accepted. But if it is negative, NPV is negative less than 0, the project will be rejected. Simply the project will be rejected if NPV is less than 0 or negative. Now in case of mutually exclusive project, what does it mean? Mutually exclusive project means you have all the capabilities or expertise or knowledge and experience to execute 2 projects or 3 projects. That means mutually exclusive. You can take up applying your knowledge, experience and capabilities and infrastructure you have. The infrastructure you have to carry out a project, the capabilities, the manpower, the knowledge, the expertise, the management, everything you have which you can use to execute more than one project, new project. You have 3 projects, suppose you have 3 projects in hand to choose from, and using your expertise, knowledge, managerial abilities, infrastructure, you can take any or all the projects. All the 3 projects. That's what is called mutually exclusive projects. But here you have to see all the requirements, all the criteria I discussed about in the first session of this class about definition of capital budgeting. You have to specify, you have to see all the criteria are fulfilled, particularly the total capital requirement and particularly If your total capital requirement does not permit, if your total capital requirement and available fund does not permit selecting all the 3 projects, you have to choose only one project, although all 3 are viable. Although all the 3 projects are viable, that means I am talking about all the 3 projects are giving you positive NPV. Suppose all the 3 projects are giving you positive NPVs. That means all the 3 projects are viable initially, but considering your capital requirement and available capital, you can go for only one project. So in that case, you will choose that project which gives highest NPV, the project having highest positive NPV. Of course, if all the projects are giving negative NPV, there is no question of choosing or selecting any of the projects. Clear? If all the 3 projects in hand are giving negative NPVs, there is no question of choosing any of the projects. But the point is, if all the 3 projects in hand are giving positive NPVs, considering capital requirement and capital involvement, available capital, if you can choose only one project, in that case, from these mutually exclusive projects, I have defined what is mutually exclusive projects. You will choose only one project, depending on your available capital and requirement of capital. And in that case, since all the projects are giving positive NPVs, you go for project having highest positive NPV. Project having highest positive NPV would be selected. Clear? Now we will go into the details of how net present value is calculated. The simple formula for net present value calculation is summation of present value of all cash inflow after tax, CIAT. CIAT stands for cash inflow after tax. Cash inflow after tax is the full form of CIAT. So present value of all cash inflows after tax, and then from that you deduct summation of present value of all cash outflows. So that gives you net present value. So this is how you calculate net present value. Now we little bit discuss about these cash flows, how cash flows are calculated. There are simple rules and formulas to calculate cash flows. Let us see these things first. These are the types of cash flows. When you talk about cash flows in project management, in capital budgeting and selecting projects under discounted cash flow techniques, capital budgeting under discounted cash flow techniques, using discounted cash flow techniques, we talk about cash flows. These are the different types of cash flows. Initial cash flows, there is outflow, initial investment, annual operating cash flows. There are 3 types of cash flows actually. 3 components of cash flows. There are 3 components of cash flows. One is initial cash outflow or outlay. This you can call is outlay also, initial investment. And second is annual operating cash flow. The word is operating. Annual operating cash inflow. Annual operating cash inflow, that is cash inflows after tax. In short, CIAT. And finally, the terminal cash flow. Terminal cash flow at the end of the project. This is terminal cash flow. The cash flow generated by the project at the end of the project, termination of the project, when the project terminated, termination, at the time of termination, that is called terminal cash inflow. That is actually in terms of scrap value of the project. At the termination of the project, when the project is scrapped and sold, it is called terminal cash flow. The cash flow generated is called terminal cash flow. Now, this initial cash outflow is also maybe called outlay. Cash outlay is also initial investment is also termed as cash outlay. Is also termed as cash outlay. It is called cash outlay. Is also termed as cash outlay. That means involvement, cash involvement, initial cash involvement, cash outlay. Initial investment comprises initial cost of the new project, installation charges, and working capital introduced. These are 3 things which are included in initial investment when you start the project. That is called initial investment comprising initial cost, installation charges and working capital introduced. Then cash inflow after tax. Calculate CIAT for annual operating cash as annual operating cash flow. So annual operating cash flow, this is CIAT, cash inflow after tax. This is calculated by using this formula, CIAT, PAT, profit after tax plus depreciation plus interest after tax. This is actually interest after tax, 1 minus T is for tax. And here of course profit after tax is after charging interest. This profit after tax is take here, it is after charging interest. That's why the formula is profit after tax plus depreciation. Depreciation is non-cash expense and interest is non-operating expense. That's why you call it operating, we call annual operating cash inflow, CIAT. CIAT is actually annual operating cash inflow. Why it is operating? Because first of all, this is cash flow, this should be cash flow. So depreciation is non-cash and interest is non-operating expenses. That's why we add back depreciation, non-cash expenses we add back with profit after tax. Profit after tax is simply income minus expenses. So these expenses, depreciation and interest are also deducted from income to arrive at profit after tax. After tax, of course, after tax. So this profit after tax is also an outflow. When you pay taxes, these are also outflow in terms of cash outflow. But this profit after tax is calculated after deducting depreciation, which is not a cash flow. There is no cash flow involved, and also after deducting interest, which is not operating expense. We are talking about operating cash inflow. So therefore, since we are concerned with operating cash inflow, depreciation is added back because it is not cash outflow. There is no cash outflow involved in this expense, and interest, there is cash outflow, but this is not operating. This is non-operating cash outflow. So that's why we add back interest also. But remember, interest you don't add back the full amount. Interest you add back after tax, because tax is outflow. So after deducting tax, whatever interest is expenses, that you interest is expense, and on that tax, in fact, interest on tax on interest is actually tax shield. It's not, you calculate tax on interest, there is actually tax shield. That means that amount of interest is actually reducing your total tax outflow. When you pay tax, calculate tax on interest, that interest, tax on interest, the tax on interest is actually tax shield, because that is reducing your tax outflow. Expense, tax on expense is actually tax shield or tax savings. You can call it tax savings. So therefore, interest is operating non-operating expenses, but from non-operating expenses you deduct tax shield, and net amount of interest is added back because that is non-operating expense. Clear? Depreciation is added back with PAT because depreciation is non-cash expenses, and interest of tax. Interest after considering tax savings on that interest payment. So that left out interest is non-operating expense. That is also again added back to PAT to get cash inflow after tax, because definition of cash inflow after tax is operating cash inflow. Clear? But you can get CIAT other way also. If you start from PAT, this is the formula. But if you start from earning before interest and tax, so here it is already before interest. Earning before interest and tax. So therefore, you simply deduct tax. Interest is already not taken, already excluded from EBIT. EBIT is before interest and tax. So therefore, interest is already out of this thing. So that with that you just add depreciation, because EBIT is calculated after depreciation. Depreciation is non-cash. So therefore, depreciation is added back with net of EBIT after tax. Net of EBIT after tax. With that you add depreciation to get CIAT. These two formula for calculating cash inflow after tax, which is annual, which are actually annual cash inflows, annual operating cash inflows. The second thing, and third, last part. Here again actually CBIT. CBIT, if CIBT is given. If here we're talking about calculation of CIAT. CIAT can be calculated using these two formula. But think CIBT, cash inflow before tax is given. If cash inflow before tax is given, these are two formula for, we have discussed how these two formula is used for calculating CIAT. Now, if CIBT, cash inflow before tax is given, if cash inflow before tax is given in the problem, then how to calculate CIAT? So these are steps. First, you get PBT, profit before tax, from CIBT. If cash inflow before tax is given, you get profit before tax by deducting depreciation from CIBT, cash inflow before tax. From that you deduct depreciation, you get profit before tax. Because that was cash inflow, no? This is just cash inflow. So when you talk about cash inflow, obviously the depreciation was not considered. Now, profit before tax, cash inflow before tax, now depreciation. Deduct depreciation to get profit before tax. And that profit before tax, you deduct tax, you get profit after tax. And as usual, with profit after tax, add back depreciation. Profit now is the same thing. CIAT, profit after tax plus depreciation plus interest. The third step is same as the first one. Third step is same as the first formula of CIAT we discussed, which is this profit after tax plus depreciation plus interest after tax. Interest after tax and depreciation are added to profit after tax. How do you get profit after tax? From profit before tax deduct tax, you get profit after tax. And how do you get profit before tax? Profit before tax you get by deducting depreciation from cash inflow before tax. So this is how you calculate cash inflow after tax, CIAT, once cash inflow before tax is given. Clear? So this is how you calculate your cash flows. And there are three types of cash flows. Initial cash flow, which is simply initial cost of new project, and installation charges, and of course working capital. So these three together, initial investment. Then you calculate cash flows, annual cash flows, and these are annual cash flows. So this is how you calculate CIAT. Therefore, if CIBT is given, the simple formula you can use here. If CIBT is given, if CIBT, cash inflow before tax, is given and there is no interest cost, you can calculate CIAT, CIBT minus depreciation minus tax and plus depreciation. First you deduct depreciation minus tax and plus depreciation, where D is depreciation, D is tax. So this is how you can calculate CIAT once CIBT is given. Now we'll talk about terminal cash flow. Terminal cash flow consists of working capital recovered. The working capital you invested at the beginning of the project, once the project is completed, the working capital is no longer required. So that working capital recovered or released, you can call it working capital released or working capital recovered. That becomes your terminal cash flow. And net cash flow from the sale of scrap. The sale of scrap and working capital recovered. So these are the two things you have in terminal cash flow. So terminal cash flow means cash flow at the end, at the termination of the project. When the project is terminated, project is completed, you get terminal cash flow from that. So that terminal cash flow includes working capital recovered and scrap, sale of scrap, proceeds of sale of scrap. Now net cash flow from the sale of scrap is calculated as follows. This sale of scrap, from sale of scrap, how do you calculate net cash flow? So that the format for that is table you can use to calculate cash flow from sale of scrap. First, proceeds from sale of scrap. The scrap value of the projects, the value at which you are selling the scrap actually, proceeds from sale of scrap, and then with that you add tax shield. What is tax shield? Tax shield is that loss, book value minus sell proceeds, the rate of corporate tax. So actually, if you make a loss by selling the scrap, see, when the project is terminated, at the end of the project cost, the value of the project. Suppose value of project at the termination, book value of the project at the termination is suppose 10 lakh. Book value of the project at the termination is 10 lakh, and even you are selling that project as scrap. At the termination of the project, you are selling that project, the book value of which is 10 lakh, and you are selling that project at the termination of the project at a price, say 8 lakh. So you are selling the project as scrap at a price 8 lakh. So you are making a loss. So in that loss, you are actually saving tax. You are in that loss. If you consider, if you factorize that loss in your PL account, if you take into account of that loss, sell of project at loss, that will reduce your profit, and that way you will save tax. That is called tax shield or benefit on capital loss. This is capital loss. Why it is capital loss? Because you are selling the project as scrap at the termination of the project. The book value of which is 10 lakh, and you are selling it at 8 lakh by incurring a loss on sell a project 2 lakh. So on that loss, you are not paying tax. That means that loss is factored in PL account, reducing your profit and leading to less amount of tax payable. So applying rate of corporate tax, book value minus sell proceeds, the loss, on that loss, applying tax rate, you get tax shield or benefit. It's called tax shield or benefit on capital loss. But if you sell the scrap at a profit, if you sell the scrap at a profit, suppose book value of the project is 10 lakh at the end of the termination, at the time of termination or end of the project, and you are selling that scrap of the project at a higher value, say 12 lakh or 13 lakh. So you are selling that project as scrap at 13 lakh at the termination of the project. So you are making profit of 3 lakh. So on that profit you have to pay tax. That you have to deduct from this proceeds of sale of scrap. So if you proceed, you are selling the scrap as, say you are selling the scrap as 13 lakh. You are selling the scrap at 13 lakh and book value of the project is 10 lakh. So you are making a profit of 3 lakh. So this is tax on capital gain. This is capital loss and this is capital gain. On that capital gain, you are making a profit of 3 lakh. The 3 lakh is the capital gain, and on that capital gain, 3 lakh, you have to apply corporate tax rate. If corporate tax is say 40%, then 3 lakh is your capital gain. On 3 lakh, 40%, 1,20,000. 1,20,000 will be deducted from your proceeds and to arrive at net cash inflow. If you sell the scrap at a profit, but if you sell the scrap at loss, that corporate tax applying on that loss will be added as a tax shield or benefit, and you get total cash flow from sale of scrap, net cash flow from sale of scrap. So discussed all these 3 types of cash flows: initial cash flows, annual cash flows, and this is terminal cash flow. Terminal cash flow comprising working capital released and sale of scrap. And from sale of scrap, what is the calculation? What is the amount of cash flow you get from sale of scrap? This is how you calculate this. An important note. That important note is what? Under straight line method of depreciation. Under straight line method of depreciation, book value and sell proceeds in the terminal year of the project are same. Therefore, there will be no tax benefit or tax loss on capital loss or capital gain respectively under the straight line method of depreciation. So under the straight line method of depreciation, there will be no such tax shield or tax loss, capital gain, tax on capital gain. So there will be no tax shield or benefits. There will be no loss of tax in terms of outflow of tax payable on profit on sale of scrap. So in case of straight line method of depreciation, this proceeds will be your cash flow. Simply speaking, in case of straight line method of depreciation, the proceeds at which you sell the scrap will be your cash flow without further any adjustment for tax shield or tax loss. Clear? Now let us understand the concept of present value of cash flows. Present value of cash flows. To understand, let us assume you are investing. One is investing rupees 10 lakh investment, maybe investment in bank, investment rupees 10 lakh, and the return of interest at interest rate, investment rupees 10 lakh, interest rate interest rate say 15% per annum. 15% per annum. That means annual compounding. That investment will be compounded annually. It means the investment will be compounded annually, and investment is 10 lakh. Interest rate is 15% per annum. That investment will be compounded with interest annually. So investment is made in 0 year. Matlab means right now. 0 year is right now. You are investing in 0 year rupees 10 lakh. Rupees 10 lakh is invested in 0 year. Okay. At the end of year 1, end of year 1. This is end of year 1. What will be the value of that investment at the rate of 15% interest? At the rate of 15% interest, the value of that investment will be 10 lakh into 1.15. 10 lakh into 1.15 will be the value of investment at the end of 1 year. Simply 10 lakh into 1.15, that comes to 11 lakh 50,000. So equals to 11 lakh 50,000 will be the value of investment at the end of year 1, right? So now end of year 2, that investment horizon is investment of rupees 10 lakh, interest rate 15% per annum, and that investment is for 3 years. Investment horizon for 3 years. 3 years. Okay? So investment is for 3 years. Now end of year 1 is this. Now end of year 2, second year. What is the value of that investment at the end of year 2? Value of that investment at the end of year 2 will be 11 lakh 50,000 into 1.15. Why 1.15? Because interest rate is 15%. If interest rate is 12%, it will be 1.12. Okay. Now let us see how much is coming. 11 lakh 50,000 into 1.15. This comes to 13 lakh 22,500. 13 lakh 22,500. This is the value of investment at the end of year 2. End of year 3. End of year 3. At the end of third year, what will be the value of that investment? Again on this, the beginning of year, see this 13 lakh 22,500 is the value of investment at the end of second year. So obviously this 13 lakh 22,500 is the value of investment at the beginning of third year. So end of third year, end of year 3, end of third year, the value will be including another 15% on this, isn't it? Another 15% on this beginning value of year 3. Since it is compounding annually, the value will get this much end of year 3. 13 lakh 22,500 into 1.15. How much is that? Into 1.15. It comes to 15 lakh 20,875 equals to 15 lakh 20,875. This is the value of investment at the end of year 3. The initial investment, the value of initial investment at 0 year, 10 lakh. 10 lakh became 15 lakh 20,875 at the end of year 3. Now, you can call the present value of 15 lakh 20,875 is 10 lakh, isn't it? Present value, at 0 year. Now, end of year, after 1 year, you will get 11 lakh 50,000. After 2 years, you will get 13 lakh 20,500 at the future value. After 3 years, you will get 15 lakh 20,875 as future value. So, of this future value, after 3 years, you can call present value of 15 lakh 20,875 is 10 lakh. Am I right? So, therefore, we call it present value of 15 lakh 20,000. We call it present value. So therefore we can say present value of rupees how much? 15,20,875. Present value of rupees 15,20,875. Receivable after 3 years. Present value of rupees 15,20,875, 15,20,875 receivable after 3 years is at the rate of at 15% interest rate. At 15% interest rate. So what is it? At 15% interest rate. 15% interest rate is how much? Equals to rupees 10 lakh. Equals to rupees 10 lakh. We actually earlier initially calculated the present value, that means the value, the money, the capital you are investing, you are keeping maybe in bank account. In bank account you are keeping 10 lakh at 15% interest rate, and bank will give you, credit your account by interest, and the value will show in your account at the end of 1 year 11,50,000, getting including 1,50,000 interest at the rate of 15%, right? And at the end of year 2, including interest compounded annually, your account will show balance of 13,22,500. And at the end of 3 years, your account will show a balance of 15,20,875, including interest at the rate of 15% for 3 years. Including interest at the rate of 15% for 3 years, your account will show a balance of 15,20,875 at the end of 3 years. That you have calculated. So that you have calculated, you are investing 10 lakh right now. You have calculated at the end of 3 years, your account will show a balance of this much with 15% interest compounded annually. Now from this calculation, we can say present value of rupees 15,20,875. Receivable after 3 years. Receivable after 3 years is 15%. At 15% interest rate is rupees 10 lakh. Now the point is, if the present value is given, we calculate future value by multiplying 1.15 because interest rate is 15%. Now if future value is known, suppose you are given the future value of 15,20,875 after 3 years at 15% interest rate, calculate the present value. How do you calculate present value? Simple. Here you move this direction, and now you simply move to this direction. See, this is just concept. I am just showing this direction and all that as for clearing your concept, as depiction, describing the concept. But practically you don't do this. Practically what you do is different thing. It's different calculation, different format and different tables. We'll see that. But here I am giving you the concept of present value. So now to calculate present value, you have to come this direction. You have to come this direction. Because in this case, you have been given, when you calculate, you are required to calculate present value, you are given this figure 15,20,875, and you have to arrive at the present value of this. If you are receivable, if you are receivable 15,20,875, what will be the present value of that 15,20,875 today? Today, what is the present value of that 15,20,875 today? So how do you calculate that? Simple. Here you multiply by 1.15. Now you simply, so here the value is 15,20,000. So you are given future value. You are given future value 15,20,000. So here you calculate. So you are given 15,20,875 receivable after 3 years at 15% interest rates. You are given After 3 years at 15% interest rate, you will be receivable 15,20,875. Now you have to calculate, you are required to calculate present value today. What is the value of this future payments receivable today at 15% interest rate? How do we calculate that? So when you calculated future value from present value, when you calculated future value from present value, you multiply it by 1.15 because 15% is interest rate. Now, when you calculate present value from future value, you simply divide by 1.15. So, 15,20,870 receivable at the end of 3 years. The value of that will be at the end of 2 years. At the end of 2 years or beginning of 3 years, third year. So better we call it at the end of 2 year. End of 2 year. End of 2 year. At the end of 2 year, the value will be 15,20,875. 15,20,875. 1 upon 1.15. Simple. You'll get this figure divided by 1.15. What is the figure you get? 13,22,500. 13,22,500. And to get this figure, end of year 1 value or beginning of year 1. Beginning of year 1 value. This is actually beginning of year 1, 0. Beginning of year. This is actually beginning of year 1, 0 year, and this is end of year. So end of year 1 value will be again 13,22,500. 1.15. So what is that? 11,15,000. 11,50,000. This is the value. 11,50,000. So 11,50,000. This is end of year 1. End of year 1 value is. This is now. After 1 year, end of year 1, the value is 11,50,000. Right? So now you have to calculate the present value. So how do you calculate the present value? Now, the value now. Again 11,50,000 into 1 upon 1.5. So this comes to 10 lakh. This comes to 10 lakh. So once you have been given this future value and given that future value is receivable after 3 years at 15% interest rate. To calculate the present value, how do you calculate that? The divided by 1.15, again 1.15, again divided by 1.15 because it's a 3 years period, 3 years horizon, investment horizon. So 3 times you will do that. So 3 times because the project, this investment is for 3 years. Investment is for 3 years. This is called investment horizon. So investment is for 3 years. So therefore, to arrive at the present value, as to arrive at future value, you multiply it by 1.15 3 times, and to arrive at the present value, you divide this future value by 1.15 3 times to arrive at this present value. So, since you are dividing this future value by 1.15 3 times, why 1.15? Because interest rate is 15%. If interest rate is 12%, you take 1.12. Clear? If interest rate is 15%, at 12%, you take 1.12. Here it is interest rate is 15%, so you take 1.15. And to arrive at present value, you divide this future value by 1.15 3 times. So, if you calculate, therefore, simply from this future value, straight away, you can calculate this present value by this technique. Future value is 15,20,875. So 15,20,875. Here, in this case, he divided this future value 3 times by 1.15. So what I am doing, 1.15 whole to the power 3. Whole to the power 3. Why? 3 times. Now you are multiplying by 1 by 1.5. That means dividing by 1.15 3 times. So I am doing 1.15 whole to the power 3. By this you are multiplying the future value. What do you get? So first of all, you just do this 1 by 1.15. 1 divided by 1.15 is this, and to the power 3. Okay? And multiply this by 15,20,875 into 15,20,875. See, this is the figure. What is the figure it is shown? 10 lakh. I am showing you this calculation again. See carefully. Here what I am doing, you are given this future value and you have to calculate the present value. So how do you calculate? I have seen in details to calculate. You for end of year 2 figure, to get end of year 2 figure, you divide by 1.15. Again to get end of year 1 figure, divide again by 1.15, and to get end of this is beginning of year, this is end of year 1, 0 year, 0, the in present value. To get the present value, again you divide this figure by 1.15. So 3 times you are dividing by 1.15, or 3 times you are multiplying by 1 upon 1.15. So straight away you can calculate this by multiplying this future value with 1.15, 1 upon 1.15 whole to the power 3. So let us see the calculation again. First you divide 1 by 1.15. 1 divided by 1.15 is this, and to the power 3 this, and multiply this by future value given 15,20,875, and you arrive at 10 lakh, which is the present value. Have you got the idea of present value, students? This is the idea of present value. So how it is calculated? Present value of this is receivable after 3 years at 15% interest rate is rupees 10 lakh. And how do you calculate that? This is 15. I am showing you this calculation again here. How it is calculated? 10 lakh. How this 10 lakh is arrived? I am doing this calculation again. This 15,20,875 is future value. 15,20,875 is your future value. And what you do here to get the present value at 15% interest rate, 3 years horizon. So this, see, if it is for 4 years, if the future value was given for 4 years, then to the power 4. You have to do to the power 4. Here the investment horizon 3 years. So 1 divided by 1.15 whole to the power 3. This equals to rupees 10 lakh. I have shown this. Actually, this is called interest factor. This is called interest factor. This is called interest factor. What is this called? This is called interest factor for calculating present value. Present value interest factor. This is called present value interest factor. Present value interest factor. This is called present value interest factor. In short, PVIF. In short, PVIF, present value interest factor. This is present value interest factor. So if you calculate present value interest factor, so you can write this implies 15 lakh 20,875 into, just calculate this factor, 1 divided by 1.15 to the power 3 to the power 3. This comes to 0.6575. This comes to 0.6575, or if you want to take another decimal, you can take 2 also. 0.6575 2, rounding off. This is interest factor. So if you multiply, see, we have rounded off. So you may not get 10 lakh, exactly 10 lakh, because we have rounded off here. But see what you get. 15 lakh 20,875 into 0.6575. What do you get? 10 lakh 5.73. So approximately you get 10 lakh. You are not getting exactly 10 lakh because you have rounded off. You have not taken all the figures, you have rounded off 5 decimal points, 5 decimal points rounded off, but you get 10 lakh, approximately 10 lakh. So you can write rupees, what do you get actually? 10 lakh 5, 10 lakh 6, rupees 10 lakh, rupees 10 lakh 5, 10 lakh 5.73. This is the figure you get, no? After getting this 1 divided by 1.15 to the power 3, you get 65752, and you take 0.65752 multiplied by 15 lakh 20,875, and you get 10 lakh 5.73, or rupees 10 lakh approximately. 10 lakh approx. You can call it 10 lakh. So this is how you calculate present value using present value interest factor. So this is what, again, your present value interest factor. So this is also, you can call it, this is also your present value interest factor. This is also your called present value interest factor. Now students, I will show you one table which you can use as present value interest factor table. This is the table which you can use as, see, this is PVIF. This is called PVIF table. PVIF, present value table, present value interest factor table, and where K is for interest rate and N is for number of years. K is for interest rate and N is for number of years. And this table is called present value interest factor for rupee 1 discounted at the rate of K%. This is the rate of interest percentage for N years, number of years. See, our interest factor was, what interest factor we calculated? We calculated interest factor at 15%. At 15% for 3 years, our interest factor was 0.65752. Let us see. From this table, here it is 10%. So you have to look out the below part of this table, below. So 15%. See, 15%, and look out for 3 years. So for 3 years, if you look out for 3 years, three years, 15%. What do you get? This is actually here this table is prepared with 3 decimal point. So if your investment is for 3 years and the rate of interest is 15%. 15% rate of interest and investing is for 3 years. What is the present value of rupees 1? Rupees 1, the present value of rupee 1 receivable. See, this is the present value of rupee 1 receivable after 3 years at 15% is 0.658. What is the present value? 0.658. And we calculated 0.65758. If you round it off for 3 decimal point, if you round it off this present value interest factor for 3 decimal point, it will be 0.658. Exactly the figure given in this table. Exactly the figure given in this table for 15% interest rate for 3 years. See, for 3 years, 15% interest rate, it is 0.658, rounded off for 3 decimal. So this is how you can calculate. Now, simply speaking, using this table, if given future value, suppose it is said future value is 50 lakh. Receivable after say 7 years. After 7 years, you will be receiving 50 lakh. Okay. After 7 years, you will be receiving 50 lakh at interest rate say 16%. I am showing you how to use this table. Once you have understood the present value, once you clear the concept of present value, how to use this present value table. See, given rupees 50 lakh. Rupees 50 lakh is receivable. Rupees 50 lakh is receivable after 7 years. After 7 years at 16% interest rate of at 16% interest rate of discount. Interest rate of discount. Or it's called, simply call it discount rate. Interest rate of discount or rate of discount. So, what is the present value? If rupees 50,000 is receivable after 70 years at 16% interest rate of discount, what is the present value? What is the present value? So how do you calculate that? What is the present value? So rupees 50 lakh multiplied by PVIF, present value interest factor, KN. K is for rate of interest, that means 6, and N is year, 7. So this is the present value. What is the present value? What is the present value of this 50 lakh? 50 lakh receivable after 7 years. How do you calculate? 50 lakh multiplied by PVIF 16.7. 16 means 16% interest rate, 7 means 7 years, receivable after 7 years. So let us find out from the table PVIF 16.7. PVIF 16.7, you have to find out. 16% interest rate, this is the 16% interest rate and 7 years. This comes to 0.354, taking 3 decimal point. Taking 3 decimal point, it comes to 0.354 for 7 years. 16.7, 0. We write 0.354. Okay. Rupees 50 lakh into 0.354. So this comes to how much? $50 lakh into 0.354. This comes to 17 lakh 70,000 rupees. 17 lakh 70,000. This is the present value of 50 lakh receivable after 7 years at 16% interest rate, using this table, present value factor, interest factor table, PVIF table. 16% and 7 years, 0.354 multiplied by 0.354. So in other words, you can call, if you invest now, in other words, you can call you can say if you invest now 70,70,000 at 16% at 16% interest rate, after 7 years you'll get 50 lakh. You'll get 50 lakh from your investment. If you invest 17,70,000 right now, after 7 years, after 7 years at the rate of 16% interest, you will get 50 lakh from your investment. This is the future value. Here 50 lakh is future value, whereas 17,70,000 is present value of this future value of 50 lakh at 16% interest rate and receivable after 7 years. Okay, so this is the concept of present value of cash inflow. Now we will go for solving the problem. This is the illustration we are going to solve. So let us read the illustration first. One company, DS Chemical, a chemical company, is considering replacing an existing machine with one costing rupees 65,000. The existing machine was originally purchased 2 years ago for rupees 28,000 and is being depreciated by straight line methods. So method of depreciation is here straight line method. And the straight line method, the machine is depreciated and new machine is costing 65. So new machine is costing costing 65,000 new machine, and the old machine was 28,000 purchased 2 years ago for rupees 28,000, and the machines are being depreciated in the straight line method, depreciation straight line method over 7 years life period. This old machine, we're talking about this old machine was being depreciated over 7 years life. 7 years life, this old machine was being depreciated, and 7 years life, and is being depreciated by straight line method over its 7 years life. It can currently be sold. So it can currently be sold at 30,000 with no renewable cost. This means this old machine, can be currently sold at 30,000 with no renewable cost. The new machine which costs rupees 10,000 to install. That means the new machine which purchase price is 65,000 will cost 10,000. New machine will cost 10,000 to install. New machine would cost 10,000 to install and would be depreciated over 5 years. That will be depreciated over 5 years. 5 years. That will be 5 years life, depreciated over 5 years. And the management believes that the new machine would have a salvage value. So after 5 years, the new machine, which costs 65,000 and installation costs 10,000, after 5 years, that new machine can be sold at a price of rupees 5,000 at the end of 5 years. After the life of this machine, 5 years, it can be sold at 5,000. The management also estimates an increase in net working capital requirement of 10,000 as a result of expanded operations to the new machine. So once you install the new machine, your production capacity will increase, as well as to increase or to cope up with increased production capacity, you have to increase your working capital also. Working capital requirements also increased, and that will increase by 10,000. Increase in net working capital. Increase in net working capital due to installation of new machine. Once you install, as a result of expanded operations due to installation of new machine in place of the old machine, the working capital requirement will increase by additional working capital. Increase in net working capital 10,000 with the new machines installed. The firm is taxed. Rate of tax is 50%. Tax rate taxed at the rate of 55%. 55% on nominal income and 30% on capital gain. Remember, 50% is for normal business income. Normal business income will be taxed at 55%, and capital gain will be taxed at 30%. 30% rate is for capital gain. The company's expected after-tax profit for 5 years, for next 5 years, to the existing machine and new machine are given. So expected after-tax profit profit after tax. Simply speaking, this is PAT. Expected after tax profit is simply, this is profit after tax. This is simply profit after tax is given. So expected after tax profit is PAT. You call it PAT. So profit after tax for these two machines, existing machines, for the next 5 years. Remember, this is for the next 5 years. See, for the new machine, the expected life is 5 years. 5 years is the expected life of the new machine. Whereas the old machine, which purchased 2 years ago, and it is being depreciated over a period of 7 years. That means this old machine also has a remaining life of 5 years. Got it? The old machine purchased 2 years ago. The old machine purchased 2 years ago at a price of 28,000 and being depreciated on settlement method for 7 years life. Its life is 7 years. 7 years life for the old machine. So old machine has got 7 years life, which purchased 2 years back. So therefore now the old machine also has 5 years life remaining, and the new machine also has got 5 years life. So both the machine now onwards, the old and new, both the machine has got 5 years life. Correct? Existing machine has got 5 years remaining life after 2 years, after purchased 2 years back, and the new machine has got 5 years life. And for these 5 years, next 5 years, these are the profit after tax from the old machine and from the new machine. Now what you have to do, you are required to calculate the net investment required by the new machine, net investment required by the new machine, or you can say net investment required for the new machine if it is installed, and if the company's cost of capital is 15%. What is cost of capital? This is the interest rate discount rate. Cost of capital is 15%. That is interest rate. That is interest rate which you discount. Determine whether the new machine should be purchased. This is the change. First, you have to calculate the calculation of investment, and actually this will calculate the process. In the same process, you will calculate this investment, and it also mainly you are supposed to calculate whether the new machine should be purchased. Determine whether, this is what we are mainly actually required to do, whether the new machine should be purchased, or whether the old machine should be replaced. In other words, whether the old machine should be replaced. You can call it whether the old machine should be replaced or whether the new machine should be purchased. Once you purchase the new machine, old machine is no longer there, it is replaced. So this is what is required. So let us solve. Actually, solution is here. I'll explain the solution, how it is done. Solution is here. First, we calculate. See, we have seen there are different types of cash flows: initial cash flow, and annual cash flow, and terminal cash flow. We have already discussed these things. There are 3 types of cash flows: initial cash flow, which is in terms of initial investment, initial outlay, and then annual cash flows, and terminal cash flows. There are 3 types of cash flows. So first of all, we will calculate the annual cash flows. How would you calculate annual cash flows? That also I have discussed. Annual cash flows, when profit after tax is given, from profit after tax, you calculate annual cash flow by adding depreciation back. Here interest is not given, so depreciation is given. So incremental depreciation, adding depreciation, you calculate incremental cash inflow after tax. So how is this? Profit after tax. So first you calculate increase in profit after tax, incremental profit. How do you calculate incremental profit? It's simple. Calculate incremental profit. For the first year, incremental profit is by installing new machine, incremental profit is 16,000. 2,16,000 minus 2 lakh. And for the second year, incremental profit is 1,50,000 minus 1,50,000, nil. Third year, incremental profit is 20,000. 2 lakh minus 1,80,000. Fourth year, incremental profit is 30,000, and fifth year, incremental profit is 10,000. So once you install the new machine, replacing the old machine, your profit will increase. Profit after tax will increase. That is called incremental profit. So put it here, incremental profit. Incremental profit, increase in profit or incremental profit. For the first year it is 16,000, as I have shown. First year it is 16,000, 2 lakh, and 2,60,000 is increased for the new machine. And second year nil, and third year 20, then 30, then 10. So this is the incremental profit: 16,000, nil, 20,000, 30,000, and 10,000. So increase in profit or incremental profit. You can call it incremental profit or increase in PAT, profit after tax. And to calculate CIAT, with PAT we add depreciation back. Here we will add incremental depreciation. How do you calculate incremental depreciation? Incremental depreciation. Let us calculate incremental depreciation per annum. Per annum, because it's straight line method. Under straight line method, incremental depreciation per annum. For the old machine, for the old machine, depreciation is simply 20,000 divided by 7 years, because the life of old machine is 7 years, so divided by 7 years. So old machine 28,000 by 7 rupees 4,000. For the new machine, purchase price is 65,000. Purchase price is 65,000 and installation cost is 10,000. New machine would cost 10,000 to install. The installation cost is 10,000 and salvage value of the new machine at the end of 5 years life, new machine salvage value 5,000. So what do you do? You know how depreciation is calculated. 65,000 plus 10,000 installation cost minus salvage value 5,000, and its life is 5 years. Its life is the old machine has life 7 years, and this new machine's life is 5 years. So this comes to 75 minus 5, 70 divided by 5, so rupees 14,000. Rupees 14,000 is depreciation for the new machine. So incremental depreciation, therefore incremental depreciation incremental depreciation 14,000 for the new machine if it is installed, and 4,000 which is now should be replaced. So depreciation is increasing by rupees 10,000. So incremental depreciation is 10,000. So why do we calculate incremental depreciation? Because incremental depreciation is 10,000. So because we have taken incremental profit, profit increased by installing a new machine in place, replacing the old machine. So incremental profit is this. So with this we add incremental depreciation, which is 10,000 every year. 10,000, 10,000, 10,000. So every year it's 10,000. So adding depreciation you get incremental CIAT, incremental cash inflow after tax. This is 26,000, 10,000, adding this 26,000, 10,000, 30,000, 20 plus 10, 30 plus 10, 40, 10 plus 10, 20,000. So these are incremental CIAT. You calculate incremental CIAT. So after you know the CIAT, what do you have to do? You have to do the calculation for present value of incremental CIAT. How do you calculate present value? We have already shown in details how to calculate present value. Multiplied by present value interest factor 15N. N stands for number of years. Cash flow CIAT after second year. This is cash flow after first year. This is cash flow CIAT after third year. Cash flow after fourth year. And you have to multiply by present value factor for 15%. Why 15%? 15% is interest rate. Interest factor. Interest factor is calculated cost of capital, and cost of capital is interest rate here. Cost of capital is interest rate. Using this interest rate, the present value interest factor will be calculated, and present value interest factor will calculate. See, there are two ways to calculate the present value interest factor. By using the table also you can calculate, you can find out the interest factor. Here we have to calculate interest factor PVIF for 15% n years. N stands for 1, 2, 3, 4, 5. So let us find out from this table 15%. This is 15% table, 15% present interest factor, and 1, 2, 3, 4, 5. Simply 15% for first year. At the end of first year, for the first year, 1 year, 15% rate PVIF comes to, see, PVIF here in this solution you will find 4 decimal points present value factor, or here in this format you have 3 decimal points. So just round it off and see. If you want, you can take 3 decimal point also, but I have taken 4 decimal points. So let us see, if you take 3 decimal point, how it is to be taken. 15%. 15% first year. 15% first year, 0.870. So here it is taken. First year 0.8696, so approximately 0.870. Second year 15%, second year 0.756. What is taken? 0.7561. So round it off, 756. Third year 15%, third year 0.658. So 0.6575, rounded off, 758. Fourth year 15%, fourth year 572, 0.572. So this is 5712, so approximately 0.572, rounded off, 3 decimal point. Then 15% fourth year is over, then fifth year 0.497, 497 is for fifth year, 0.497, 4972, so rounded off, 4972. So this is how, using table, you can find out present value interest factor, PVIF, 15% interest rate for n years, 1 year, 2 year, 3 year, 5th year. So this is by using PVIF table. But I am showing you how you can do this only simply using your calculator. Simply using your calculator, how you can do that? As I have shown in earlier calculation, once you do the present value calculation, here I have shown you, this is the present value factor we get. In this case, the present value factor was this. How it is this? 15% interest rate for 3 years. 15% interest rate for 3 years, present value factor is this. Okay. So using this formula, if it is for 4 years to the power 4, if it is for 5 years to the power 5, if it is for like that. If it is for 2 years, then to the power 2 square. So using this formula, you can calculate, instead of using the table, you can calculate here the present value factors, PVIF. So how do you calculate that? Here again, there is a simple technique. So what do you do? I tell you, I have checked this present value factor from table. Now I am going to calculate using the calculator this present value factor. How do you do that? Here, just look at this calculator and how it is being calculated for the first year. For the first year, here interest rate is 15%. Okay. So for the first year, what do you do? For the first year, 1 divided by 1.15. 1 divided by 1.15 plus answer equals to. So what do you get? 0.8695 something. So 4 decimal point rounded off. If you take 4 decimal point rounded off, 8696. 8696 is the 4 decimal point rounded off figure. So take it here, first year. Now second year. To get a second year figure, what do you do? Simply, now just follow what I am telling you and just do that. Press answer. Answer, then divided by again 1.15. 1.15. Okay? Press equals to. What do you get? 7561. Are you getting it? 7561? You get 7561. This is here also 7561 for the second year. Okay? And for the third year. For the third year is actually how much? 0.6575. So what do you do? What you have to do with this calculator? Simply press equals to. Just equals to. Press equals to. What do you get? see 6575. So 6575 is the present value factor for third year. Okay, and for the fourth year it is 0.5718. What do you do? Simply press equals to again. What do you get? See 5717. 57175 here, so round it off, 4 decimal point round it off, 5718. The 5718 is the present value factor. And for the fifth year, again press equals to, you get 4971 something, 717, so round it off, 4972. So 4972. So 4972 is your present value factor for the fifth year at 15% interest rate. Okay, so this is how you can calculate the present value factors using calculator. Okay, now after you calculate present values, PVIF, present value factors, multiply this incremental CIAT by present value factors. Multiplying these present value factors, you get present value of incremental CIATs. This is present value of incremental CIATs. Actually, what is this? This is annual cash, present value of annual cash inflows. This is present value of annual cash inflows. Present value of incremental cash inflows. Incremental cash inflows. This is present value of annual cash inflows. Okay. Now total it up. This, after multiplying these present value factors with this incremental this is present value factor, and these are incremental CIATs, present values. These are actually annual cash flows. These are annual cash flows. Annual cash flows, CIATs, multiplying these CIATs by present value interest factor, and you get present value of cash inflows. This is present value factor, PVIF, and this is cash flows, annual cash flows, CIATs, multiply CIATs by present value factor, you get present value of cash flows, annual cash flows, CIATs, cash inflows after tax. So these are present value of annual cash flows. So present value of annual cash flows. That means cash flow received in year 1, present value of this. Cash flows received after 2 years, present value of this. Present cash flow after 3 years, present value after 3 years is 30,000. But this is the present value. Cash flow after 4 years is 40,000. This is the present value. Cash flow after 5 years is 20,000, and this is the present value. Present value. Now you calculate present value of terminal cash flow. Terminal cash flow is, in terms of, here it is given the problem, the terminal working capital. What is the working capital? Working capital was 10,000. Then that will be released. This is the release of working capital, and the salvage value of the new machine. Salvage value of the new machine is the terminal cash flow. At the end of the project, once you replace the old machine by new machine, the new machine has got salvage value. The new machine has got salvage value of the new machine, and that salvage value is 5,000, and that 5,000 is salvage value after 5 years at the end of the project. This salvage value you receive after 5 years at the end of the project. Similarly, working capital you invested at the beginning of the project will be released after 5 years. The working capital will be released after 5 years. This is the salvage value, and working capital released after 5 years. So what is the working capital invested in the beginning of the project? 10,000. That will be released after 5 years, so 10,000. So these 5,000 and 10,000 you receive as the terminal cash flow at the end of 5 years. So to get the present value of these cash flows at the end of 5 years, you multiply by present value factor at the end of 5 years. For 5 years at 15%, present value factor is 0.4972. We have already calculated that, right? So if you want to calculate that, you can calculate it again. How? 5 years. 1 divided by 1.15, 50% interest rate equals to these to the power, for 5 years to the power 5. So this comes to 49717. Rounded off 4972. That's what we have taken here. 4972 is already calculated shown earlier. So 4972. So why 4972? 5,000 you receive after 5 years as scrap value from the new machine, and 10,000 is the working capital after 5 years. So this is 4972 multiplied by this, and these two are terminal cash flows. These two are terminal cash flows. So adding terminal cash flows with initial annual cash flow, present value of annual cash flow, present value of annual cash flow, and these two are present value of terminal cash flow, and this is total. So do this total here. So total preview of all cash inflows. These are total present value of all cash inflows. After calculating total present value of all cash inflows, here it is the present value of all cash inflows, 90,167. How it is coming? This is present value of annual cash inflows, total present value of, see this 82,709 present value of cash inflows, this is actually total of these things. This one 22,609, 7,561, 19,725, 22,870 and 9,944. So sum of all these is actually 82,709. So 82,709 is present value of total cash, annual cash inflows, annual cash incremental CIAT annual cash inflows. This is present value of annual cash inflows, all annual cash inflows, and with that we add present value of terminal cash inflows. These are two terminal cash inflows, and these are the two present values of terminal cash flows. This is salvage value of new machine at the end of 5 years, and this is the release of working capital at the end of 5 years, and this is the present value factor for after 5 years, and they multiply this present value of terminal cash flows, these two, and this is total present value of all cash inflows. This was annual cash inflows, these two are terminal cash inflows, present value of terminal cash inflows, and this is total present value of all cash inflows, total present value of all cash inflows. This is 90,167, and from that we deduct initial investment. Initial investment, not outflow or outlay. So the initial investment, how do you find that initial investment, initial cash outflow? Cost of new machine is purchase cost and installation cost 75,000, and additional working capital 10,000, and capital gains tax payable. How do you calculate capital gains tax? The old machine which was acquired, cost of acquisition 28,000 and sold at 30,000. So capital gain here is 30,000 minus 28,000, 2,000. On capital gain 2,000, 30% is tax payable, 600 is outflow. Tax in the form of tax, capital gains tax, 600 outflow, and tax on profit and sale of old machine. So how do you calculate profit on sale of old machine? Actually, total gain from sale of old machine is 30,000 minus 20,000. 20,000 is present value, book value. Present book value is 20,000 of the old machine and 30,000 is sell price. Total gain is 10,000. So out of 10,000, 2,000 is capital gain. Out of 10,000, 2,000 is capital gain, and remaining 8,000 is profit. And on profit, tax is 55%. So 55% on 10,000, 8,000. 55% on 8,000 profit, tax comes to 4,400. That is outflow. This is profit on tax on profit. 4,400 is profit on profit, tax on profit at the rate of 58%, and this is 600 capital gains tax 30% on capital gains of 2,000. Profit is 8,000. On profit, tax is 55%. 4,500 is tax outflow. So total outflow is in the form of tax is 5,000. 4,400 and 600. These two are tax outflow in the form of tax, capital gains tax and corporate tax on profit on sale of old machine. So these are two outflows, and 10,000 working capital, and this is cost of acquisition of new machine. So total outflow, total investment, and from that total outflow, from that you again deduct 30,000. This realizable value of the old machine. So old machine, if you sell old machine, 30,000 becomes your inflow, initial inflow. So these four, 75,000, 10,000, 600, 4,400, these are initial outflow at the beginning of the project. And at the beginning of the project, when you sell, if you sell the old machine by 30,000, this is sell price. 30,000 is sell price of the old machine from which you get capital gain. So 30,000 becomes your inflow, initial inflow. So net initial outflow, initial investment or initial outlay, 60,000. How it comes? This is acquisition cost of new machine, including installation cost, 10,000 working capital investment, 600 capital gains tax on sale of old machine, 4,400. This is tax on profit of 8,000 at the rate of 58%. So this is the outflow, and this is inflow, initial inflow. Initial inflow is the form of sale price of old machine, 30,000. So net initial outflow or outlay, net outflow or outlay is 60,000. All this plus this is 5,000, 5,000 plus 78,000, 80,000 plus 10,000, 90,000. So 90,000 minus 30,000 is sell process of old machine. 60,000. So 60,000 is your initial or at the beginning of the project outlay. This is the outlay or net outflow, 60,000. So that is deducted from total present value of cash inflows, all cash inflows. Total present value of all cash inflows is 90,167. From that you deduct initial cash outflow. The present value of initial cash outflow is the same because it is multiplied by 1. Present value factor is here 1. For this initial outflow of 60,000, present value factor is 1. So multiplied by 1, the present value of all outflow or initial outflow is 60,000, and this is present value of inflows and this is present value of outflow. So present value of inflow minus present value of outflow is your net present value. The formula for net present value we saw. This is the formula for net present value. Net present value is sum of present value of all cash inflows, and this is your present value of all cash inflows minus present value of outflow, cash outflow or cash outlay. Present value of cash outflow. Here present value of cash outflow is 60,000. So subtracting this from inflows, your net present value 30,167 is net present value. So this is net present value. Net present value 30,167. So what was the requirement in the problem? In the problem, the requirement was to calculate, first of all, calculate investment requirement. Investment requirement by the new machine. That means net outflow. This is actually investment requirement net outlay or net initial investment. This is net initial investment. Net initial investment. This is what? Net initial investment. Investment required. Net initial investment is how much? 60,000. 60,000 is net initial investment because calculate the net investment required by the new machine. So net initial investment is 60,000, which you calculated this 60,000. 60,000 is net initial investment. So here the comment is net investment required for the new machine. Initial investment as above calculated is to be 60,000. And what is the second thing required? Second thing required, determine whether the new machine should be purchased. So obviously new machine should be purchased because NPV is positive. Here net present value is 30,167. This NPV. This is NPV. This NPV, net present value. Net present value. Net present value. So net present value is 30,167, which is positive. Which is positive. So since this is positive, we should decide the person. What is the question? Question was determine whether the new machine should be purchased. So since net present value, this is the net present value of, this is the net present value of what? This is the net present value of the decision to replace the old machine. What we have done? We have calculated, we have computed net present value of decision to replace the old machine. Since the value of net present value of this decision is positive, net present value of this decision to replace the old machine and installing the new machine is positive. Therefore, as the NPV is positive, it is decided to replace the existing machine and obviously installing the new machine. Okay, that's all for this class today, students. Thank you for listening. Thank you for giving your patient hearing and attending the class and following the video. Thank you, Bill. Thank you very much. Thank you.